What's up, YouTube? It's Kenny again. Sitting here in Rochelle, Illinois, waiting to roll out this morning. It's about 7 o'clock. I had to go pick up and go to Cedar Falls, Iowa to deliver today. Wanted to make a video today to talk about diversification. Somebody in the comments asked why I don't own more stocks, and was kind of railing on me about not being diversified. Okay, so before we get started, pay attention. I'm not a financial advisor. I'm just a truck driver driving across the country researching and trading stocks, and I will not be held responsible for any moves you make in the stock market. Not ever. I am not your mama. Okay, do your own research, make your own decisions, and take responsibility for those decisions. If you're new to the channel, please hit that subscribe button. I noticed I picked up some subscribers lately. Welcome to you guys. Hit that like button for me. Leave me a comment. And consider supporting the channel by joining the Patreon, which is down in the description below. All that money goes toward me building a retirement. I'm not a rich guy. These big YouTubers don't need your support. I do. I'm trying to build a retirement for myself. And all the money from YouTube revenue, Patreon, from my other channel, Patreon associated with that, t-shirts associated with that, all goes into the M1 Finance account, which is currently up about 16%. And the next deposit on the M1 Finance is going to be, I forget the exact number, it's right around $260 or something like that. And that'll be coming sometime around the 21st. So let's talk a little bit about diversification. Let me roll this window up. It's getting a little bit loud here. So let's talk a little bit about my thoughts on diversification, okay? Because a lot of people like to have their money spread way out and stuff. And I understand that is the prevailing philosophy that, financial advisors will tell you to diversify, okay? But I think for myself, I rail against the things that the financial advisors tell us most of the time. And I don't believe what they have to say, because they are of the mentality that we should all be trying to build wealth very slowly over long periods of time. And I'm getting a late start, and I'm not interested in building wealth slowly over a long period of time. And I, for my purposes, am willing to take on risks in order to build wealth faster. And I say wealth, I just want to build as much as I can for a retirement, okay? Diversification is not the way to do that, okay? I thought it was Charlie Munger, but it was actually Mark Cuban who said that diversification is for idiots, okay? And Warren Buffett said that if you're confident and you're professional about it, really he would advocate for large amounts of concentration. In other words, doing lots of research, becoming very confident in specific companies, and concentrating your money into those companies, okay? Now, obviously Warren Buffett's view would be more of something like Coca-Cola and things like that. But that's just not where I am. And even if you watch YouTubers like Jeremy, who's made a lot of money in the stock market, if you watch some of his videos where he talks about how to start investing, he will tell you smaller amounts of stocks so that you can pay attention. See, that's the thing. If you have smaller number of stocks, you can pay very close attention to what is going on with those companies, okay? As you have been investing longer, you are maybe better able to pay attention to a larger number of companies, And truth be told, if you're not in these startup growth type companies that I'm in, you may not have to pay quite so close attention to them because they're more established companies. But the companies that I'm invested in large part, which aren't very many, are companies that I need to pay very close attention to the news and to what is going on with those companies, and I don't want to spread that out too much and not be able to keep track of it all. Okay, so that's part of the reason why I don't diversify. But the main reason, okay, that I do not have a wide, diverse portfolio is because it kills your gains, okay? The idea of diversification is that it cushions losses, is that it protects you against losses, because when a few things are going down, you still have a bunch of stuff that's stable or that is going up. But what happens is when you have a few of those companies that go way up, you have a bunch of those companies that are stable or are barely moving, and it kills your gains. Like, because this is all a percentage game, okay? And when you have a small amount of money like what I have, maybe 12,000 total in the stock market, when you have a small amount of money like that, when you spread it out over 30 stocks, okay, you don't have very much money in each stock. So you can't capitalize on big gains because you have so many stocks that you have, say you have 3 or 4 of those 30 stocks that double, but the rest of them pretty much stay the same, some of which go down, some go up a little. You just killed all those gains. Whereas if I have my money in 4 or 5 stocks, if a couple of those stocks do really well, I catch those gains. And that's what I'm looking for. I'm looking for big gains, okay? And I'm willing to take the risk of exposing myself to when stocks go down in order to get those gains, okay? That's why I'm not diversified, because it kills your gains. Yes, it protects you from losses, but it also kills your gains. I prefer to be in stocks that I've done a ton of research on, buy them when they are in crisis and low, knowing, because I have a lot of knowledge about that company, knowing that I am confident that they will go up, so that I can tune out all the noise and just trust in my research and what I think about the company. And then I have no one to blame but myself if I lose money, because it's my research I'm relying on. I'm not paying attention to the articles and the analysts like I talked about in that Lordstown video. Those people are not on my side, and they are looking at these stocks from a completely different perspective than what I'm looking at them from. I'm not trying to look 10 years out. I'm not even trying to look 5 years out. I'm trying to look months, maybe a year out, and try to capture big gains, okay? I've been successful at it so far. I mean, I've had some downtimes. I'm in one right now, you know what I mean? Because I was up at about a 60% return. Then I was back up to 35. After being way down, I was back up to 35, and now I'm back down to about 20. But the thing is that I have confidence in these few companies that I am in, that I will be able to catch a big ass pop and get out with a huge profit. Now, you see, I mean, you can see by looking at how they behave if you're paying attention to the stocks that I look at, okay? OEG, every time a news story comes out, you get a big ass pop, okay? You got 115% pop on that last one, on that one before last. And then yesterday or day before, you had one come out and it went like 30-some% in the pre-market, okay? You're getting big pops on news stories. And normally, I don't stay in stocks as long as I have right now, but we had this big pullback in February. I positioned myself into a small number of stocks that I know are going to come back from this correction, or whatever you want to call it. And now I'm at the point where I'm just now getting back into the spot where I'm waiting for the big pop to sell, okay? And that's where I am right now. It's worked out exactly how I thought it would. You know, in phase, I knew it would take a little longer with them, but the other stocks that I'm in have come back, you know, and they're hovering around the green, and all I need now is a couple of big pops and I'm out. But see, if I had a bunch of other stocks like Berkshire Hathaway and Walmart and all these stocks that are safe, then when looking at the totality of my account, the total money that I have invested, if I caught those pops and sold them, I'd have a much smaller amount in there, and all these other stocks would have stayed still. And so the total amount of my account would not increase by a very big percentage. And I'm looking at it as a percentage game. So, like, say for instance, Lordstown Motors, if it pops like I think it will, and I make $3,000 off of that, okay, that's nearly 40% of my total holdings. If I had a fifth of that amount of money in there and the rest of my money was spread out over a bunch of stuff that didn't pop, then I might have got 5%. You know what I mean? I'm looking for the big pops. I'm looking for big gains, and that's why I don't diversify. Now, as my account grows larger, eventually I may get to a point to where I want to diversify more. And if you look at the first video I did where I explained what all is in the M1 Finance, where the YouTube money is going, you know, I've got like, you know, over 10 stocks in there, and it's much more diversified, and several of those, among those 10 stocks, are ETFs, which diversifies it even further. So I do understand the concept of diversity, but in my main account that I use, which is my Roth IRA, diversity is not my strategy. My strategy is to identify companies that I think are going to pop big and make me money, and try to grow my money that way. So I know a lot of you don't agree with that strategy, don't like that strategy, but you know, I mean, I hate to say it, but I'm a very smart dude, okay? And I'm able to look and see the reality of what's going on with these companies, and I trust my mind, I trust my intelligence, I trust my research, and so I feel confident doing it. And that's what Warren Buffett said. If you have the confidence in the companies that you're investing in, he would recommend high amounts of concentration. But for the rest of everybody, he says they should participate in diversification, and which is basically the same thing that Mark Cuban said when he said diversification is for idiots, for people who either are unable or unwilling to do the work necessary to identify companies that they'll really be able to make money on, pay attention to them, track them. You know, for everybody else, mutual funds and S&P 500 funds and stuff like that, and then you just put your money in there and you don't mess with it. But me, I'm driving down the road with the stock market open on two sources all day. Like, that's all I do. Like yesterday, I rode down the road, and all day I just watched Lordstown Motors and I watched OEG. And that's all I did all day. All right. A lot of people don't have that luxury. They don't have the ability to just look at it all the time. And I understand that, you know, but I do. And so I'm using that to my advantage in the stock market. That's it. That's what it is. All right. Thanks for watching. Hit that subscribe button, like the video, leave me a comment below, and join the fucking Patreon. Thanks for watching.